Gautam Trivedi joins us now. Gautam, thank you for joining us. Gautam, they say in the market that if you've lost 15% in this fall, you are outperforming. So are you outperforming in this fall?
I am actually, but there's a reason because I'm sitting on a lot of cash. And not that we saw the Ukraine and the Russian war getting to this level, but we were very wary about the upcoming rate hikes for the US Federal Reserve. So we were more in cash than I guess some of our peers, I would assume. So yes, we have been outperforming as a result.
On the cash. So were you sitting on the cash or are you still sitting on the cash? Because if you're still sitting on the cash, that means that you expect markets to go lower.
No, good question. We have actually started to deploy over the last couple of days, and you can't time the bottom, and I know a lot of people think they can, but we certainly can't. And as a result, again, the question is, how bad does it, how ugly does this get? Is this the worst that we've seen, or does Putin go after other countries? We just don't know. And if the commodity, even if Putin and Ukraine basically come to some sort of a ceasefire, I don't think the sanctions go away within a couple of weeks. They will stay for some more time. So the impact that we've seen on commodities across the board, and given the fact that Russia and the Ukraine are the second largest producers of commodities in the world after the United States, that I think is a major cause for concern. And that's inflationary, and obviously would mean that the Fed may be compelled to move faster than they thought they would. So yes, we have started to nibble and actually started buying stocks that we think have reached our price points.
Good morning. So can you tell us that you've had this cash on the table, and now that you started deploying it, you've started buying stocks that you think have reached the value you want. Which ones are these?
I can't share the names, but here's the way to look at this, and that's the I guess let me answer your question slightly differently, and to obviously the viewers who are watching this. If you look at the market as a whole, and we've seen from the bottom on the 23rd of March 2020, when global markets crashed, the Nifty rallied 144% up to October of 2021. Now, if you see thereafter, that's when the FI selling actually began, and we've seen a major correction of almost 16 to 17% since then. And the correction continues. The FI selling also continues, and I don't see that slowing down anytime soon. But what that's done is, while the headline index has not fallen as much, the individual stocks within the BSE 500 universe have fallen significantly. So I was doing this math yesterday. 95 stocks have corrected 40% or more from their respective 52-week highs. 394 stocks have corrected 20% or more from their respective 52-week highs, which effectively tells you that the 80% of the BSE 500 stocks are in a bear market. So there is plenty to choose from. And frankly, anybody can just run a screen and you'll be able to find some amazing stocks that we thought were invincible and have had actually major corrections.
It's a fantastic way of looking at it. And we've also been talking here about the churn that we've been seeing towards the broader universe. So when you bring out that kind of math, especially for the BSE 500, it all falls in place as well. Gautam Trivedi, in September 2021, we had you on the channel and you said you would rather own the new age tech stocks that were going in for IPOs. We've seen the kind of correction that's taken place. And you had said that you would rather own them than the HULs and the Nestles. Do you still subscribe to that view?
Yeah, I think what has happened is what I did say, and you're absolutely right, that a lot of these companies, whether it's the Swiggies or the Zomatos or the Airbnbs, which is not listed here, but I'm giving examples of companies, of the new age tech companies, that are changing the way we live. They're changing the way we behave. So as a result, I would continue to own these stocks. What has corrected are the valuations, and that's really, I think, the good news. So will people stop buying from Nika and actually go into a Shopper Stop or a retail store to buy what they want from the cosmetic monthly or annual cosmetic purchases? Some of that may still happen, but the fact is, the 2 years of COVID has significantly changed and altered the way people shop now. So that some of those things are here to stay. I mean, hybrid work from home, work from office is also somewhat here to stay. So a lot of these things actually are starting to get into our DNA. And as a result, I don't think the tech companies are bad companies. It's just the valuations were bad, and now is a good time to actually start looking at them.
Interesting take there. Gautam, also wanted to understand, the biggest correction perhaps has panned out in the entire banking universe. And, purely because of the kind of weightage that they have and the bearing that they have on the overall index, it looks a little bit more alarming. Wanted to understand, where within banks do you find value, or do you find value at all or not?
No, I think I do find value in the banks. And, there are certain banks that have gotten punished more than the others. So for example, if you look at ICICI Bank, the ADR until recently, at least until yesterday, was trading at a 3.5% discount. So it makes perfect sense for FIIs to actually buy the ADR and short the local. So you've seen some of that impact starting to unwind now. And as a result, I must tell you, we own ICICI Bank, but I was citing that merely as an example. So we've seen some corrections coming into the banks. But like I've said in the past, as in the recent past, our bets are on banks that are moving faster than the others on digitization, and that's really what's going to happen. If the others don't move fast enough, you'll have literally a bunch of kids coming out of Stanford or coming out of the IITs and launching a fintech company, which will do extremely well and eat into the business of the traditional banks. So that's where we put our money.
And IIMs, you're forgetting them, but anyway, that aside.
Yes, I meant them too, yes.
The other pocket, of course, is the geopolitical crises, geopolitical crises sensitives, right? Your oil sensitives, for instance, your ONGC and Gales of the world. And then there is the metal basket on the other hand. Even though we were talking to one of the steel players, and they said because of the geopolitical crisis, exports would actually see a jump up and prices will remain buoyant. We wanted to understand how you're now treating these pockets.
That's a good point. I think what I said at the outset was, even if the war ends sooner or later, I hope it does, will the sanctions remain for several more months? The answer is yes. So if you look at commodities as a basket, as an asset class today, today, the 9th of March, versus equities, I personally believe that commodities will outperform equities as an asset class throughout this year, and steel being no exception. So yes, the best way to play that would be to buy and look at some of the steel companies, some of which have had a bit of a correction.
What could be the worst case scenario? Let's say crude stays above $100. It stays not at 130, but between $100 and $110. Are markets pricing in high energy prices, or do you think equity markets have already factored that in? Because Gautam, we both know that it is not important to do rear view driving. I mean, you do that on road, but in markets you have to do front view driving.
Yeah. No, very good question, Anuj. Here's my 2 cents on this. The 2 problems that we have annually in India, one is the monsoon and second is the price of oil. And both of which cannot be determined, even with all the analysis that you may possibly have. Nobody saw oil hitting as high as this even until 2 months ago, right? So that remains a clear issue. But having said that, I think $100 is, well priced into the markets today. The one thing which people need to get clarity from the government is really their state of finances. Because unfortunately, as we know, divestments haven't taken off. We've had 2 years of the biggest bull market on the planet, and we still haven't had much success in divesting or privatizing companies. And that does exert pressure on the government's finances. So as a result, and the other problem, of course, is that the government of India and the state governments, to some extent, to a smaller extent rather, remain the biggest consumers of capex, and actually they're the only ones actually doing real capex. So that has to somehow, the government needs to figure out its math and maybe step up its privatization efforts as and when the market stabilizes. Because otherwise, by merely raising prices at the pump level in India, 18 rupees a liter, or as the case may be, that's going to be inflationary. That's going to hurt the economy even more. So the last thing you want to do is start hurting the economy, and you need to find out other means of actually compensating and paying for the extra oil bill.
So, what to your mind is the new range for this market?
Sorry, Nikunj, can you repeat that, please?
What to your mind is the new range for this market? Let's say the range at the beginning of the year was, in a sense, between 17,000, 16,500 to 18,500. After this reset, where do you think, in terms of the market range, the market will settle into a distribution phase, or it will settle into a sideways consolidation? Where do you think that market will start reaching what is called as fair value or true value?
You see, here's what I think has actually happened to the market. When the FIs selling began in October of last year, honestly, we have to thank the local population of India, which has been pumping money month after month, tens of thousands of crores into the domestic mutual funds, plus participating individually. So had it not been for that, this market would have been down at least 25%, if not more, from the peak that we achieved in October. So I think if you look at the year 2020, the FI investment hit a new record of $23.5 billion, and that's what carried the market up 80% from the March lows of 2020. If you look at last year, FI buying was a mere $3.8 billion, which was nothing, right? And the domestic stepped in, domestic retail, domestic mutual funds, which also means retail, because retail's putting money into the domestic mutual funds. And that's what saved the market from actually having ending the year significantly lower. This year to date, 2022, we've already seen $9.5 billion of selling. And a lot of that has actually been supported or mostly offset by domestic buying. Now that domestic buying, I don't think is going to slow down anytime soon until rates go up significantly. So today, if you're getting 5.25% on a State Bank of India fixed deposit with a 3-year lockup, that's nothing. I mean, really, that is pre-tax. So for investors to start looking at alternative avenues of investment away from the equity markets, rates need to rise by at least anywhere from I would think 150 to 200 basis points for them to actually start looking at fixed income as a real alternative. So I don't see the market having a significant correction until that happens, in spite of the daily selling by FIs.
So we've spoken about banks, and I want to revisit that point once again. Now, the easy argument why banks have fallen is because FIs are selling, you own what you sell, and they own private banks. But our market's telling us something different. Our market's telling us that growth will remain low. Our market's telling us that inflationary pressure will eat into savings. Our market's telling us that demand will not be that strong and credit will not pick up. So the technical aspect I understand is FI selling, FI selling. But is the real story slightly different why banks are underperforming?
No, I think the banking system has seen tepid loan growth for the past, I think at least 24 months, if not longer. So that, and like I said during this interview, that the government, the whole country is looking up to the government to actually do real capex, because the private sector is not really stepping up as of now. But I think the correction in the banks has also been driven by, I think, the overall sluggishness in the economy caused by COVID. And of course, I think one of the best ways, or the best replay plays right now, reopening plays, should I say, would be the banks. So I would still remain focused on picking the right banks and buying them versus trying to play NBFCs at this point.
Okay, that's a quick word that's come in as far as financials go. Now, Gautam, typically when we see the kind of volatility, uncertainty, the money goes into the defensives, right? Whether it is IT, yesterday once again we saw strong buying, as well as pharmaceuticals.
Yeah.
Is that another way to play at the markets at the moment? Because it's safe.
I don't think so. I mean, given the correction that I just mentioned to you, 80% of the BSE 500 stocks have corrected 20% or more, i.e. are in a bear market. Why would you want to play defenses right now? I would today start accumulating some of the fallen angels and start looking at those stocks, because it's too late to get into defensive. You should have done that maybe a month ago. Of course, I'm not saying anybody had a clue on how ugly the war would get, but the problem is now to get into defensive is, I think, a little late. There's a lot of value emerging from both mid caps and large caps, and I personally focus on that.
And just given the kind of correction that you're talking about, the 80% kind of correction that you're talking about, mid caps would obviously be more attractive because they're the ones that have also seen a lot more of the correction than the large caps.
Yes, that's absolutely true. So again, you've got to be very selective. And I think this year, 2022, is really going to be the year of active fund management, i.e. Fund managers will have to roll up their sleeves and actually try and find the right stocks versus getting lucky. And the last 24 months, anything and everything was moving up rapidly. So there are pockets of opportunities even today, as of literally today, where I see great value emerging. Cement, for example, a lot of the stocks are down anywhere from 25 to 40%. And given all of the capex that the government has promised and will, I'm sure, deliver, there is going to be an urgent need for cement. There'll be an urgent need for housing, which continues and has seen a significant revival, especially in the bigger cities. So I think cement, just to start an example, is one way to play this.
So on a net basis, are you more bullish on the pure play realty names, or is it more the ancillaries, your cement, paints, sanitary ware, etc.?
I would actually play some of the ancillary plays, like Asian Paints, for example. We don't own the stock, I'm not recommending it, but the stock's corrected 26%. I mean, that's a huge move for a giant company like Asian Paints. So everything along the ecosystem of real estate has had a major correction. And I think now's a good time to start looking at those stocks.
The pocket that I want to talk about, Gautam, was also what's happening within autos. And, big disruption is playing out there, and a disruption for a while. I mean, now we understand from our sources that M&M perhaps is going to come out with an EV SUV next. But that said, the disruption, I guess, first took place in the two-wheeler space. How is it that you're going to dissect the two-wheeler / passenger and the CV market with the EV disruption on its way and such a huge competition there from the unlisted players within at least the two-wheeler segment?
As of last week, there were 46 players in the electric two-wheeler space. I mean, that's a huge number. However, there are only two ways to play today. If you look at the listed spaces, Bajaj Auto and Hero. Hero, of course, is sorting out issues internally within the family and how they will brand it and how they'll distribute their EVs. But it's a matter of time before that is sorted out indeed and will hit the market. So as a result, I only see two ways to actually play the two-wheeler EV space today. Of course, that could change as more companies get listed over the next few years, but I don't see that. I mean, as in calendar this year, I don't see visibility of any new companies coming. On the passenger car side, I think the only pure play listed company is Maruti. Maruti, for some odd reason, has decided not to rush into the EV space. They don't think the time is necessarily now. So I would rather play the EV through a Bajaj or a Hero Motocorp. We do own Bajaj in our fund currently, for that very reason, by the way.
There's a necessity is the mother of invention, and innovation always is a solution to crisis. Why am I using this example for the benefit of our viewers? Just to establish a point, and I'll throw it to you for a question, for your thoughts, which is that look at what COVID crisis has done. It has taught us the power of digitization. It has taught us the power of accelerating vaccine process. It has taught us the power of more sharing in terms of data. So Gautam, this energy crisis, if not a crisis, a shock, do you think by the time it settles down, it will be a lot of innovation which will happen, whether it is in the energy space, supply space, EV space, ethanol space, alternate fuel space, and every country now will like to focus on that because nobody wants this kind of an embarrassing situation that you're dependent on somebody else for your energy needs.
I sure hope so. I think this should accelerate alternative energy sources and the entire ecosystem there. I think Putin has threatened $300 a barrel of oil, but I don't think he understands that if it even goes to half of that, that significantly ends up making the case for alternative energy even stronger. So yes, the answer is the rest of the world, including India, I think has realized the impact of what a single war in the world can lead to, and as a result, I think everyone should and will accelerate their R&D, their deployment, whether it's green hydrogen, whether it is EVs, CNG, as the case may be. But you'll see a lot of that happening now. Yes, definitely.
That into a thought, into a market opportunity. By ethanol companies, by EVs we've discussed, so I'll avoid EVs. Ethanol, solar, what would you say that this energy shock will force you to think as a portfolio manager?
I think ethanol certainly would of course, to the extent that it can be blended. I'm not a technical person, so I don't know how much of ethanol can actually be blended with petrol. But I think when I look at the listed space, we have to again be practical of what's available today to play them versus what could list, in the future, 3, 4, 5 years from now. So unfortunately, there aren't too many ways to play this, and I think people have gone and bought Tata Power, people have gone and bought NTPC, and so forth. But you haven't seen that level of, as yet, the availability of direct plays in India. And I think that will change over the next 12 to 24 months as more companies within the alternative energy space get listed in India.
Okay, let's wait for that, for the alternative energy stocks to make their way to the Lal Street. Gautam Trivedi, it's been a pleasure having you on the channel today. Thanks so much for sharing with us what you're doing in these volatile times and how you're deploying your cash.